Part 1. The Shadow in the Market. There are moments in history when the world seems to fall apart. Moments when the confident voices of prosperity fall silent, replaced by panic, confusion, and despair. In those moments, the financial markets, so strong, so certain, reveal their fragility. Confidence evaporates, prices collapse, fortunes disappear. To most, these are times of fear. But to a rare few, these moments are opportunity. This is the story of one such man, a man known not for building during boom times, but for remaining calm when the world lost its footing. A man who waited in the shadows, studied chaos, and made his boldest moves at the very moment others froze. Some call him the philosopher of finance. Others call him the sage of cycles. But during the darkest storms of the global economy, when banks failed and nations trembled, he earned another name. The Vulture of Wall Street. His name is Howard Marks. Howard Stanley Marks was born on April 23, 1946 in Queens, New York, a child of post-war America, a time when the United States stood triumphant, hopeful, invincible. But for many working families in Queens, life was modest, practical, grounded. There were no Wall Street skyscrapers outside his window, no hedge fund elites, no signs that this boy, quiet, analytical, contemplative, would one day influence the thinking of some of the most powerful investors on earth. Howard's father worked in a small business, and his mother devoted herself to raising the family. This was a world where discipline mattered, education mattered, hard work mattered. Howard learned early that success wasn't loud. It was persistent. He excelled academically, not because he sought attention, but because he wanted to understand the world. While others memorized answers to please their teachers, Howard studied why things worked. He wanted to see the patterns that others overlooked. At 11, his parents bought a small set of encyclopedias. Howard devoured them, front to back. The world was a puzzle, and he intended to solve it. When it came time for university, he attended the Wharton School at the University of Pennsylvania, one of the most competitive business programs in the United States. Wharton was a different world. Here, ambition was currency. The students were sharp, fast-talking, hungry. Many dreamed of Wall Street, wealth, and prestige. But Howard wasn't interested in making money quickly. He was interested in understanding how money moved, its rhythms, its psychology, its cycles. Even then, he was an observer first, an investor second. Wharton sharpened his analytical mind. Yale University, where he later earned his master's degree in finance and accounting, sharpened something deeper. It taught discipline, patience, skepticism, traits that would one day become his trademark. But at this stage, Howard Marks was no legend, no icon, just a young man with a resume and a curiosity about markets. His first real step into the world of finance came in 1969 when he joined Citicorp, one of the largest financial institutions in the world. He entered the field just as a storm was forming. The late 1960s were filled with optimism, economy expanding, middle class rising, markets reaching new heights. But beneath the surface, cracks were forming. Cracks unseen by most, but not by Howard. He watched, he listened, he learned. And then came the 1970s. A decade of inflation, oil crises, recession, and doubt. A decade where the stock market entered a long, painful stagnation. The financial world shifted, and Howard shifted with it. At Citicorp, he was tasked with analyzing an overlooked category of investments, companies that had been downgraded from investment grade to junk status. Most analysts wanted nothing to do with them. They saw only risk, failure, and embarrassment. Howard saw something different. He saw mispricing. Investors avoided these companies not because they understood them, but because they feared them. This fear created an opportunity. This was the birth of his investing philosophy. The greatest profits are made when others are terrified. Not reckless profits, not speculative gambles, but carefully calculated, deeply researched opportunities hidden in the rubble of crisis. This idea would follow him for the rest of his life. But to understand Howard Marks, you must understand one word: cycles. To him, the market was not random chaos. It moved in repeating waves: optimism to greed, greed to euphoria, euphoria to collapse, collapse to despair, despair to recovery. Most investors rode these waves blindly, acting on emotion, but Howard refused to surf. He stood on the shore, watching the tide. He understood something most investors never accept: you cannot predict the future, but you can prepare for it. Humans repeat the same emotional mistakes: overconfidence at the top, panic at the bottom. Howard studied these emotions like a scientist observes the behavior of animals, not with judgment, but with curiosity. His analysis was cold, analytical, and deeply philosophical. Markets rise, markets fall, not because of numbers, but because of human beings. This lesson became the foundation of his career. In 1985, Howard met Bruce Karsh, a bright lawyer and investor with a sharp mind and a steady temperament. The two recognized something rare in each other: a shared belief in unemotional, disciplined investing. Together, in 1995, they founded Oaktree Capital Management. This was not a flashy hedge fund. No aggressive marketing, no bold predictions, no promises of overnight riches. Oaktree specialized in distressed debt and unconventional investments, areas where fear ruled and few dared to tread. The firm's philosophy was simple: be cautious when others are confident, be bold when others are afraid. This was not theory, it was practice, and they were about to prove it. The late 1990s were an era of unstoppable confidence. Technology stocks rose to absurd valuations. Commentators declared a new economy, free from traditional rules. To most, it was a gold rush. To Howard, it was a warning sign. He wrote a memo to his clients: calm, measured, precise. He warned that markets were overheating, expectations were unrealistic, euphoria was clouding judgment. Few listened. When the dot-com bubble burst in 2000, trillions in market value vanished. Millions lost savings. Companies disappeared almost overnight. While others panicked, Oaktree moved quietly. They bought what was still valuable, at prices crushed by fear. Howard didn't celebrate the crash. He simply acted according to the principles he had spent a lifetime refining. This was his art. But the world had not yet witnessed his defining moment. Because soon, the global financial system would face its greatest crisis since the Great Depression. The year was 2007. Housing markets across the United States were booming. Banks were confident. Investors were euphoric. Credit flowed freely, recklessly, dangerously. Howard watched the same cycle unfold again. Optimism turning to greed, greed turning to recklessness. He warned once more in his memos: risk is high, caution is warranted. Then in 2008, the world collapsed. Lehman Brothers fell, banks failed, millions lost homes, stock markets plunged, the global economy froze. It was catastrophe. But in the ruins, Howard Marks saw what he had trained his entire life to recognize: value. Oaktree began purchasing distressed assets at historic lows, not wildly, not impulsively, but methodically. Howard was patient, disciplined, unemotional. While others fled the market, he moved into it. This is when the financial press gave him the name: the Vulture of Wall Street, the one who feasts when others fall. But to those who understood him, the name was misleading. A vulture feeds on the dead. Howard invested in what could still live. In crisis, most investors ask, how do I avoid losing? Howard asks, what is it worth and what is the price? This question, simple, rational, unemotional, is the core of crisis investing. And this is the art Howard Marks perfected. He once wrote, you cannot control the market, but you can control your decisions. In the chaos of global panic, this principle set him apart. It is not dramatic, it is not emotional, it is not heroic, It is steady, it is thoughtful, it is enduring, and it made Howard Marks one of the most respected investors of the modern era. But the story does not end here. Because the world did not stay stable. The crises kept coming. Europe's debt crisis, China's slowdown, oil price collapses, pandemics, war, inflation shock, banking instability. Each time, markets panicked. Each time, voices cried that this time was different. But Howard Marks had seen the cycle too many times. He knew, human psychology does not change. Only the headlines do. And through every storm, his philosophy remained constant. Be rational when others are emotional. Be patient when others are frenzied. Be skeptical when others are confident. Be bold when others are afraid. This is not just investment strategy. This is the art of crisis investing. The art of seeing clearly when the world is blind. Part 2. The Architect of Calm. When the world panics, most seek safety. They sell, they retreat, they try to preserve what remains. But Howard Marks did something different. He stepped forward. Not recklessly, not boldly, but deliberately. With discipline sharpened over decades of study, reflection, and observation. To understand Howard Marks is to understand how he thinks, not what he thinks, but how. Because Howard's advantage was never secret knowledge. It was never special access. It was never insider information. His advantage was clarity, a mind that could see through chaos without being absorbed into it. In his memos, the writings that made him famous among investors, Howard explained the single greatest error that destroys wealth, the belief that the future can be predicted. He wrote, "We can't know where we're going, but we can know where we are." This is the core of his philosophy, not prediction, but positioning, not forecasting, but awareness. This idea seems simple, almost trivial, but in practice, it is extraordinarily rare, because the world rewards confidence, even when confidence is empty. Financial television celebrates bold predictions. Investment banks sell forecasts. Analysts produce endless charts, graphs, and models. Yet again and again, the future refuses to be modeled. Recessions arrive without warning. Booms last longer than logic says they should. Tears and triumph alternate without pattern. Howard did not try to predict these turning points. He simply observed where the crowd stood in the cycle. Were they fearful? Were they greedy? Were they euphoric? Were they despondent? Markets are made of people, and people are predictable in only one way. They repeat their mistakes. Howard called this idea second-level thinking. Most investors, he said, stop at first-level thinking, "This company is good. This market is rising. This stock will go up." The second-level thinker asks, "How many others already believe this? What is already priced in? What happens if the future is different from expectations? What is the market not seeing?" Second-level thinking is not complex mathematics. It is psychological awareness. It is understanding that the value of something is not the same as its price. Price is driven by emotion. Value is driven by reality. During booms, price rises far above value. During collapses, price falls far below it. Howard's job, the job of a crisis investor, was to look through the fog. Oaktree Capital became a fortress built on this principle. Their specialty, distressed debt. These were loans and bonds issued by companies that were struggling, restructuring, or collapsing. To most investors, they were radioactive, symbols of failure and risk. But to Howard Marks, they were opportunities hidden in plain sight. Not every failing company is doomed. Not every distressed asset is broken. Sometimes a business is merely misunderstood, temporarily impaired, or trapped in a cycle. If you can understand the difference between permanent impairment and temporary fear, you may find tremendous value. But to do this, you must be comfortable with ambiguity. You must enter the places others avoid. You must study companies in their darkest moments. And you must remain calm when the world is terrified. The markets are not fair. They are not rational. They are not efficient in the short term. They are emotional systems, driven by human behavior. Howard once observed, "In order to be a superior investor, you must think differently from everyone else. And you must be right. Thinking differently is not enough. Being right is not enough. You must be both at the same time. And doing so is only possible when you build a worldview grounded in patience, skepticism, and humility. These traits are rare in finance, but they were the foundation of Oaktree's culture. It is here, at the heart of his philosophy, that we encounter a paradox. Howard Marks is known as the Vulture of Wall Street, the one who feeds on the fallen. But when Howard invests in crisis, he does not celebrate the collapse. He does not profit from suffering. He simply understands that in every moment of panic, something remains valuable. Something is overlooked. Something is mispriced. Something is waiting for recovery. He invests not in wreckage, but in survival. And survival, in finance as in nature, is often invisible to those focused only on loss. To understand how this works in practice, we must return to 2008. The global financial crisis did not happen suddenly. It built slowly, quietly, piece by piece. Household debt grew. Banks took greater risks. Mortgage securities were packaged, restructured, resold, layer upon layer, until no one knew what anything was worth. The system was a tower built on confidence. And when confidence cracked, the collapse was immediate. Markets fell, businesses closed, families were displaced, countries trembled. Fear was absolute. In that moment, most investors saw disaster. Howard saw mispriced assets, loans trading for pennies on the dollar, companies valued below the worth of their physical equipment, debt securities priced as though failure was certain, when in many cases survival was likely. He moved, slowly, carefully. With research so deep it bordered on forensic. He bought securities others considered trash, precisely because the world was too terrified to think clearly. And yet, he did not see himself as a hero. He saw himself as a custodian of rationality. He once wrote, "The goal is not to be risk-free. The goal is to be risk-aware." His job was to understand risk better than others. Not avoid it, not fear it, understand it. Oaktree's performance during the crisis was not a miracle. It was the logical result of a lifetime of preparation. When markets recovered, when prices normalized, when fear faded, the investments purchased during the darkest moments rose in value. This is how fortunes are made in crisis. Not through courage, not through luck, but through discipline applied when discipline is hardest. But the story did not end in 2008. The world continued to change. The rise of China, the European debt crisis, technology dominance, zero interest rates. Then later, inflation, geopolitical tension, and pandemic shock. Through every era, Howard Marks continued writing. His memos, humble in form, quiet in tone, became some of the most influential documents in modern finance. They are read by billionaire investors and small individual investors alike. One of his most famous readers was Warren Buffett. Buffett once said, "When I see Howard Marks's memos arrive in my inbox, they're the first thing I open and the first thing I read." This is respect of the highest order. Not because Howard is loud, not because he makes bold predictions, but because he explains the world clearly, patiently, accurately. In a world of noise, he speaks quietly. And that is why people listen. There is another concept that shaped his thinking, something he called the happy medium. Howard believed that great investing is not about extremes, not total caution, not total aggression. It is about balance. The balance between risk and safety, between optimism and pessimism, between courage and caution. This balance shifts depending on where we are in the market cycle. When markets are euphoric, the balance shifts toward caution. When markets are terrified, the balance shifts toward boldness. This is not intuition. It is a discipline built over decades of observing cycles repeat. Howard often emphasized humility as the investor's greatest defense, because the moment you believe you understand the market fully, the moment you believe the future is certain, the moment you believe your decisions cannot be wrong, you are already defeated. He wrote, "The biggest investing errors come not from information or analysis, but from psychology. The mind breaks before the portfolio does. Investors lose not because markets fall, but because they react to falling markets. They panic, they cling, they chase, they fear." Howard's strength was not emotional numbness. It was emotional understanding. He recognized fear as a signal, not to run, but to think. There is a quiet scene that captures this better than any analysis. During a period of heavy market volatility, a younger investor once asked Howard Marks, "How do you stay calm when everyone else is panicking?" Howard paused. He did not speak in metaphors. He did not offer philosophy. He simply said, "I prepared for this." And in that sentence rests the core of his art. Investing is not reacting. It is preparing. Preparing for volatility. Preparing for uncertainty. Preparing for surprise. The world is unpredictable. But your response does not have to be. Howard Marks did not become the Vulture of Wall Street because he sought to profit from ruin. He became a master of crisis because he understood something timeless. Panic is temporary. Value is enduring. And the investors who survive and thrive are those who can tell the difference. Part 3. The cycle that never ends. There is a moment in every market cycle when silence falls. No headlines, no excitement, no panic. Just a quiet, uneasy stillness. It is the moment when nobody knows what comes next. For most investors, this is the hardest moment of all. Not the crashes, not the euphoric peaks, but the uncertainty in between. The space where doubt lives. Howard Marks built his career by navigating this silence, by understanding that uncertainty is not a flaw in the system. It is the system. The world believes markets move because of growth, innovation, profits, and economic logic. But beneath the numbers, something more primal moves them. Fear and greed, hope and despair, confidence and doubt, the human condition. The cycle never ends because human nature never changes. This is the truth Howard spent a lifetime writing, teaching, and demonstrating, calmly, patiently, consistently. To understand how he thinks, we must examine one of his most enduring ideas. The market cycle is psychological, not mathematical. Economists build models. Analysts build forecasts. Banks issue projections. But Howard watched the world ignore all of them, again and again. He saw boom periods born not from reason, but from belief. Investment manias fueled not by profits, but by stories. Crashes triggered not by logic, but by fear of loss. He wrote, "Most people want certainty in a world that is inherently uncertain. This desire, this longing for stability, is the very thing that causes instability. Because when people believe the market is safe, they take more risks. They borrow more. They consume more. They invest more. Confidence becomes euphoria. Euphoria becomes recklessness. And the cycle turns." Howard described this turning in 3 phases. 1. The few know. In the beginning, a small number of disciplined investors recognize value when others overlook it. They buy quietly, steadily, rationally. 2. Everyone knows. As prices rise, more investors take notice. Confidence increases, the crowd begins to join. 3. Everyone believes. Eventually, belief replaces analysis. Everyone assumes the trend will continue. Risk is forgotten. The peak is formed not by value, but by emotion. And then, the cycle breaks. Not because of one event, not because of a specific trigger, but because belief itself reaches saturation. There is no one left to convince. The price collapses not from lack of strength, but from lack of buyers. And just like that, fear returns. Howard Marks did not try to time these turning points. He simply watched. He asked, where are we in the cycle? Are investors optimistic or pessimistic? Are they greedy or fearful? Are prices high or low relative to value? Through this lens, the market becomes readable, not predictable, but understandable. A map, not a calendar. A compass, not a clock. If part 1 was the story of origins and part 2 was the story of method, then part 3 is the story of legacy. Because Howard Marks did not simply succeed in crisis investing, he shaped how future generations would understand it. His memos, once quiet letters to clients, are now studied in universities, investment firms, and boardrooms across the world. Not because they teach what to buy, but because they teach how to think. They teach patience in a world of urgency. They teach skepticism in a world of exaggeration. They teach humility in a world of ego. In an interview years later, Howard said, "You can't control the market, but you can control your behavior." This is the heart of wisdom. We do not choose the storms we face, but we choose how we stand in them. In 2012, a remarkable moment occurred in Howard's career. A phone call came. It was Warren Buffett. Buffett offered to buy a stake in Oaktree Capital, not as a trade, not as a speculation, but as a vote of respect. Buffett rarely partners. He rarely endorses. He almost never aligns publicly with other investment firms. But he recognized something in Howard Marks, something rare and enduring, a mind not driven by ego, a philosophy grounded in reality, a discipline built to withstand time. The partnership should not be misunderstood. It was not the merging of two personalities. It was the alignment of two worldviews. Both men built fortunes by refusing to rush, by refusing to panic, by refusing to accept the illusions of the crowd. They were not gamblers. They were not speculators. They were observers. And observers survive. But perhaps the most profound chapter in Howard's story came later in life, not during crisis, not during investment, but during reflection. He began to speak more openly about the true nature of success. He wrote, "We do not succeed because we are bold. We succeed because we are prepared." Success, in his view, is not about intelligence, not about ambition, not about power. It is about consistency, showing up, thinking clearly, acting rationally, repeating over years, decades, lifetimes. The world celebrates dramatic wins, but most real success is quiet, slow, unseen, just like the cycles he studied. We live now in an era of constant noise, financial screens flashing numbers every second, opinions released faster than they can be evaluated, predictions shouted with confidence, forgotten as soon as they fail. Attention is the new scarcity, patience the new advantage. And yet, Howard Marks remains calm. His tone has not changed. His writing has not changed. His thinking has not changed. Because the world changes, but human nature does not. Fear remains fear. Greed remains greed. Cycles remain cycles. And the art of crisis investing remains the same as it was when he first studied downgraded bonds at Citicorp in the 1970s. Look where others will not look. Think what others will not think. Act when others will not act. And above all, remain steady. The final lesson of Howard Marks is not financial. It is philosophical. We are taught to fear uncertainty, to avoid it, minimize it, eliminate it. But this is impossible. Uncertainty is not an obstacle to life. It is life. The true investor and the true human being does not seek stability from the world. They seek stability from within. Howard's writing is not about markets. It is about self-control, self-awareness, self-respect. The investor who cannot control themselves cannot succeed. The investor who can needs very little else. In the end, The art of crisis investing is not the art of financial mastery. It is the art of emotional mastery. To stay calm when the world trembles. To think clearly when others unravel. To remain patient when others rush. To act when others freeze. This is the rarest discipline in the world. Howard Marks mastered it. And this is why he became the quiet legend of Wall Street. Not a conqueror, not a speculator, not a gambler, a watcher of cycles, a student of psychology, a custodian of rationality. The market will crash again, the cycle will turn again, fear will return again. But those who study Howard Marks will know the cycle is not something to fear. It is something to understand, because the cycle never ends, and neither does the opportunity within it.